All right, welcome back. The market is up a little bit, but not very enthusiastically, I should say. 36 points, 17,428 is where we're at. Vikash Kumar Jain is strategist at CLSA, and he's joining in for some market talk. Vikash, great to have you with us here. Thank you very much for your time. So, are we at a bit of an inflection point? You run that kind of sentiment index. What is that telling you? If you've kind of if you've looked at it recently, one way to look at it is, will the markets come back to the lows of the budget day, and perhaps we've taken some froth off, and things should get better from here. The other way is, there are no real big triggers, right, for the market to do well, or for people to come in aggressively. So maybe it continues to see this drift lower. I wanted your thoughts on this.
Hi, thanks for having me. So I think when you tell an inflection point, there has to be some powerful move on the other side. I would say, just since you specifically ask on the sentiment index, that's our proprietary India Bull Bear Index. That index has recently gone back into bearish zone from neutral, but this is around 17-18% bullish kind of a zone, or 82% bearish. It's not really extreme. What I typically look at as calling extreme is when we hit less than 10% bullish. We are not there yet. So from that perspective, yes, the market is lighter for sure, but it's not really in what can be traditionally called at an extreme bearish point, which leads to a contra move. So yes, it's a lighter market, but it's not really at that point of time where I can thumb the table and say that everyone is too bearish and maybe we could have a contra move. Not yet.
Okay, Vikas, hi, good morning. Thanks for that. Just let's talk about individual sectors, right? Banks have been the biggest underperformers for the last many months. But I was going through your note where you say that the risk reward for the overall sector has improved quite a bit, with valuations being undemanding. So is it a good time to be buying banks? If yes, which are the ones that you like between private and public?
I think you're referring to the analyst note. I think, yes. So I mean, that's the opinion of our banks team, that yes, there is that could be a point where, on a valuation basis, some of the banks are looking good. However, what we need to understand is India is simply catching up to, or there is some kind of a reversion to the outperformance we've seen over the last 2, 3, 4 years. And, this is versus China or versus the EM markets in general. And since flows could reverse in a situation where India is no more the darling market, that's changed rather dramatically. I mean, when we had our conference, and I think that could have also been the time when we last spoke in November, that is the time when everybody still wanted to be positive on India and, see how much the last 3, 4 months have done to us. So from that perspective, I would say that any big move for this large sector would clearly depend on flows. Since it's a reasonably well-owned sector till very recently, overweight banks was a pretty consensus call, although, that's something which we also need to bear in mind. One needs to look into that from a perspective of what happens to the overall markets. It's going to be tough for that sector to do well without the overall market improving. So, it's such a large weight.
Hi, Vikas. Good morning. Vikas, what about earnings? Suddenly we're getting a little bit cautious on earnings. Earlier, maybe 4 or 5 months ago, everyone was considering mid-teens is a given for the next couple of years on EPS growth. How much have you scaled back earnings? And now what are you working with for FY24 and FY25? Do we get to that 1,000 odd mark?
So, good question. And this is where it's interesting. In fact, this particular quarter, consensus downgrades were not so large. It was only about 1 to 1.5% downgrade by consensus in Nifty earnings for FY23 to 25. In fact, we did not really move our estimates much. On the slight, could have been a slight upgrade for CLS estimates, because we started the year and the quarter where we were 7 to 8% below consensus. Now at the end of the quarter, we are like 5 to 6% below consensus. So, we're still 5 to 6% below consensus. So from that perspective, we still expect some downgrades, but so far, it's not been that bad, at least the reporting season. other than the oil marketing companies, expectations were better than at least our estimates.
Vikas, I put out a piece looking at earnings again, this earnings downgrades, upgrades picture. And what I found was that, and this is the best estimates on Bloomberg, for Nifty 200 set of companies, right? About 57% of companies saw downgrades to their FY24 estimates. So maybe, so that is, so 113 out of 200 companies saw downgrades. And if you look at the where the downgrades were, the biggest downgrades were, I mean, the entire consumer space, right? I mean, the consumer durable space, Crompton, Whirlpool, Dixon, the retail names, ABFRL, Page Industries, Info Edge, Jubilant Foodworks, pharma names. I mean, pretty steep cuts.
That's right. But if you think about it, those are actually stocks which do not have that large a contribution to overall Nifty earnings. Like, for example, banks were still okay. They had a pretty good quarter. Banks and commodities actually have a far bigger share in earnings of Nifty as compared to, say, for example, some of these commodity names. They do not have that much of a share.
So you're talking about Nifty earning. Okay, got it. Sorry. No. My only point was broader market. Sorry, go on. Yeah.
I was talking about Nifty earnings, since that's what we popularly track. We started with 7 to 8% below consensus. Now we are 5 to 6% below consensus.
Okay. The other trend that I wanted to talk to you about was the risk to the monsoons from the El Nino, and that's causing perhaps a lot more accelerated pressure in the rural markets. That's something that people are forecasting. So it could impact tractor demand, it could impact the small car segment, rural consumption as well. And this is a space that's already ailing. What do you do here? Do you stay away from these names or do you look to buy the dip?
Yeah, so I think we've actually stayed away from consumption for a long time. In fact, from October, we run this focus portfolio where we only look at large and liquid names. 10 to 15 large and liquid names is what typically our portfolio makes up for. We've not had any weight in consumption since October. Only recently, we added one stock, which is not really dealing with rural so much. It's more of a premium and urban consumption stock, which we added. So beyond that, we have no exposure to consumption. In fact, even in the recent quarter that passed by, we tried to look at the overall quarter as a more bird's-eye view, where we kind of got into creating some groups and comparing them. One of the groups that we created was rural and first was consumption versus investments, and in general performance of capex and investment linked stocks in the quarter gone by was much better than consumption linked stocks. And within consumption, we further broke it down as the next leg as urban and rural consumption. And clearly the urban consumption stocks were still doing well. So, there was some hope that if the monsoon is normal, and that should give a kind of a boost to rural consumption. If there are risks to that as well, then of course there's going to be a hit to that, as that expectation as well. What we need to appreciate is that the government in its policy making is clearly focused on the investment in the supply side. Despite this being the last budget ahead of the last full budget ahead of the elections, or the primary elections 24, the government has not done anything specifically for consumption in general. So I would say that consumption will only slowly pick up unless there is some kind of a push that comes in. The route through investment flowing into demand is a slower process. So that's why we need to be a bit more patient. But the problem is many of these consumption names are still trading at very expensive valuations, like 1 to 2% earnings yield in a world which has gone from US bond yield being 1% to 4%. So I would say that that's something which kind of limits their ability to do well in a market where rates are likely to stay high and their demand push is not going to be very evident.
All right. Well, we leave it at that. Vikash, thanks a lot for joining in and have a great 2023 until we speak again. That's the word coming in from CLSA on the overall macro.